focus. Ideate, innovate, enable.
We are kicking off a new series called Managing Risk. This series is run up to India Risk Management Award, which will be hosted sometime in March this year. Talking about risk, who better than Bhargav Dasgupta, MD and CEO of ICICI Lombard General Insurance Company. He understands the business of risk very well. Bhargav, welcome to the show.
Thank you, Ravi.
Bhargav, if I may begin by asking you, various surveys indicate that embedding a sound risk culture is still in its infancy. In India, 64% of non-financial companies have indicated that the risk management roles and responsibilities are not formalized. Only 20% of the respondents said they have a formally articulated risk appetite among the staff. There is a tendency to glorify firefighting but not put in place a robust risk management system. What's your take here?
Your survey is absolutely right, Ravi. I'll give you a different story to embellish the same point. So we, given that we are in the business of risk management, we do these surveys, we do these seminars. So about a couple of years back, we had this big workshop with some of the CFOs of leading organizations.
Okay.
Not just the top 10, top 20, but across the spectrum. And we asked a question that how many of you have a proper ERM framework, which is an enterprise risk management framework. What struck me as amazing was that not only did a large number of people didn't have one, some of them didn't even know of what an ERM was.
Oh.
I think the issue is deeply cultural, as I see it. I think as Indians, we somehow think that anything bad that has to happen will happen to someone else.
Will happen, okay.
Let's focus on the good things. Let's go ahead and build a business fast. Make a lot of profits. We don't worry about risk as much as we should. Having said that, we are seeing a change.
Okay.
I think when some of these events happen, for example, some of the unfortunate catastrophic events that happened in the last 2 years. Last 2 years has been a very unusual period for India. We've had 4 catastrophic events in a period of 2 years, which is very, very unusual anywhere in the world. So
unusual from the risk management point
from
of
a risk management from a risk management perspective,
Yeah.
absolutely. So when something like this happens, or when GFC happened, when the overall mood of the economy shifts very, very rapidly from very high positivity to a deep despair, which we faced till the new government came into power, we see people becoming more and more sensitive. So I think the point is valid, that it's still not deeply ingrained, but I am positive that we will see some change.
But do you feel that organization should define risk appetite and bring everybody on the same page?
The answer is obviously yes. I mean, if you look at, we coming from financial services background, we do that as a matter of routine. When we design our own plans, we look at what is the kind of risk that we are willing to take. What is the value at risk for our financial exposure that we take. What is the limits that we take in terms of the event exposures, the cat event exposures that we take.
Okay.
So we don't want to do anything which bets the bank if you are in a banking industry, or bets the insurance company if you are an insurance company. That's part of our DNA in financial services. But we don't see that, as I said, in non-financial services as much as we do here. So to answer your question, the answer is yes. We need to look at the overall risk management framework, build in limits to various scenarios in terms of, if these scenarios happen, what will the exposure and appetite that you have for that exposure, what will the hit that you will get to your P&L, and are you comfortable with that quantum of risk that you're taking. I'll just give you a story. So one of the things that we see very, very regularly is corporates take insurance for the sake of checking the box. In the sense that your assets may be worth 10,000 crores, but you cover, let's say, 1,500 crores of limits, what we call underinsurance. So recently we had
is it more like meeting the compliance?
It is absolutely right. It's, as I said, check the box, but not really true risk management.
Okay.
So recently we had a situation where in this cyclone Hudhud, a facility which got damaged severely, the client realized that they had underinsured. And today they're struggling, and today they're wondering what to do about the fact that the total damage that they have incurred will not be paid because they never covered all the exposure. Yeah. So it's only at the time of calamity that people wake up to risk management, and that's unfortunate.
Bhargav, companies fail at risk management because they fail at one of the two fundamentals: cross-functionality and proactiveness. Your comment?
Look, I think the more deeper issue is that it's not culturally ingrained in our mindset in most corporates, and this starts from the top. Unless you embed the entire ethos of managing your business in a sensible manner, focusing on risk management while you're looking at building your business, you will never get any of these in place. But after you build the culture, of course, in terms of implementing it, it has to be cross-functional, because risk is embedded in various parts of the organization, and you have to come together to analyze and understand what is the correlation of those risks across various functions. So it has to be considered across all functions, and of course it has to be proactive. You can't come back, as you said, once the horse has bolted.
Do you see people getting into risk management only for product basis or project basis?
So again, it depends on which organization you're talking about. As I said, I'm seeing a trend where more companies are becoming much more conscious of risk management than they were in the past. And what is of interest is that typically the more well-managed companies which have consistently performed even in the good times and the bad times, those are companies which are much more conscious of risk management. And in these companies, they don't look at risk management in as an event or as a project or as a product.
Okay.
They look at risk management in a more comprehensive manner. One of the things that we are doing with some of these companies is actually, even from an insurance solution perspective, we are sitting down with them, looking at their entire risk status, and working with them in terms of creating solutions to reduce the risk per se, rather than just looking at payment when the risk happens, when the calamity happens. We are working with them to see how we can reduce the risk a priori. So that's something that we are seeing as a trend, where some companies are becoming much more proactive and looking at it, not just at a project or a product level, but across the company level.
So are you saying to say you're proactively involved with the client? Suppose the client is doing an M&A or client is launching a product. Are you involved at every stage there?
What we do see is in certain types of risk, basically risks that the insurance industry covers, we are finding some companies which are willing to get us inside their factories, get us to do risk evaluation, get our safety teams to analyze their safety processes, and give them solutions in terms of mitigating or reducing the risk. And this is happening in, let's say, fire, property, those kind of exposures where a catastrophic event could damage your assets. A fire could burn down your factory. It is happening in transportation risk. When you're shipping your goods from one part of the country to the other, there are a lot of small damages that happen. Companies are looking at how to control those damages. It is happening even in, for example, employee health, where people are looking at how do I reduce the overall health risk of an employee rather than just paying claims when they fall sick. So that mindset is coming in. But has it come to the level that you're talking about in terms of even at the time of launching a product, start with the probability of product recall and work with insurance companies a priori? We've not gone that far as yet.
Bhargav, I want a comment here. A labor strike at Maruti's Manesar plant saw a loss of $150 million. Pesticide found in Coke and Pepsi, worms in Cadbury's, and a whistleblower stating that Ranbaxy was submitting untrue statements. Each of these incidents denote different kinds of risk. So there are newer and newer kind of risk, but ultimately has a bearing on the top line and bottom line. So how do you negotiate such eventualities or manage risk here? Do you regularly review your client portfolio?
Look, one of the things that we in the insurance industry have been developing, globally is the entire area of liability, various liability that happens in terms of some of these unforeseen and unexpected events that come in and create a brand damage. Okay. So there is some amount of work that happens globally in terms of developing products to mitigate or rather compensate for these losses. But I don't see in India insurance companies are brought into these discussions with corporates as yet, where we are discussing these issues with them a priori. But what is happening is, even when we are consulting them at the time of buying their liability products, we do have extensive discussion in terms of their entire strategy in terms of product development, entire strategy in terms of how do they look at some of these risk management practices, and accordingly we end up pricing these products. So there is some amount of dialogue that is happening, but not to the extent that we would like to see. I would think so, yeah.
Is risk management reduced to form filling exercises? What is the sense you get when you look at India's top 500 companies?
I would say, I would classify them into three buckets. I mean, there is a set of companies which, as I said, are typically the well-managed and consistently successful companies who take risk management very seriously. And these could be large organizations, they could be very professionally managed organizations. Most financial services companies do take risk management very, very seriously. There is a set of companies.
But there are also all these Basel rule, regulatory rules.
Absolutely.
Compliance rules are where financial companies are concerned.
Absolutely, but I'm not limiting this definition only to financial services. I'm saying there are a lot of other companies which are in non-financial services sector who are progressive and who look at risk management very, very effectively today. There is a set of companies who've not even woken up to this challenge. I mean, they look at it very, very reactively. And I think there is a set of people who are transitioning, and we see that's the trend that I talked about earlier. We see a large number of companies beginning to realize that this is a material issue that they need to address, and we are seeing, as we dialogue with our companies, because we are with them in their risk management solutions, we see the trend developing. So I can't kind of paint all the top 500 companies in the same brush. They're in different state of the journey towards.
You can't put them in one basket.
Absolutely.
Okay, this is an interesting one. Policy reversal by the new government can alter business landscape or profitability. That's a political risk which nobody has control over. So how do you tackle that one?
That's been a request from some of our clients. Can you provide us an insurance policy for something like this? We've not been able to. So I don't know how to mitigate this risk, but I guess that's for our policymakers to be conscious of. And at least what we are hearing is that there is much greater consciousness that this is not good for business. Because at the end of the day, if that happens, investment flees from that country, which does some of these things that you're.
So one is the political, the other thing is the power of social media and its ill effect on the reputation of business. It's not regulated at all. Social media, it can tarnish a management's reputation, things like that. Also, some messaging there could be a run on the bank. It has happened in the past.
Yeah.
So what kind of advice would you give your clients if this kind of happen, or would you cover such kind of risk also? Before
I get to social media, one of the areas where there is an increasing trend of risk is this entire cyber risk, where if you see some of the very large US-based bank was recently under big attack, and that has huge impact in terms of liability suits potential in that market. So not just in terms of reputation damage because of social media chatter, these are real events in terms of cyber attacks and the consequential damages. So one of the things that we do talk to companies which are exposed to that risk, which is typically, as I said, more B2C companies, financial services companies, companies which are selling goods directly, let's say online, and highly reputed brands as well, is the entire focus on managing your trust quotient with your customers, not only in terms of what you do on the social media, but even otherwise, is very, very material. And at the end of the day, when the social media chatter does happen, it will happen, there will be some events like some of the examples that you gave earlier. It's very important to have a very, very focused, dedicated team which is constantly monitoring the social media conversation that is going and react to it as fast as possible. And react in a manner which is simple, plain, transparent, honest, rather than making it a very legalistic response. It's very important to have almost human-to-human conversations rather than making it a very corporate conversation. And that's something that I think people are beginning to learn.
How can companies become more resilient to risk then?
I think the first step is to have the culture ingrained in the organization, and that, as I said, starts from the top. And once you decide and agree as an organization that this is important and inculcate that culture within the organization, then comes the framework. And there are existing frameworks which I won't bore your audience with, but the framework includes areas where you need to work together, set up monitoring mechanisms, set up matrices, review those matrices. We, for example, in every quarter, board meeting, we talk about our risk management, status. We have our dashboards which monitor how the risk is moving. Is it going up, going down? Which are the high risk areas? How is it moving? So you need to have those dashboards and monitor them and take corrective actions, which you again review in terms of the impact.
In this case, you help your client with this kind of dashboards.
We've shared some of these best practices with some of our clients who are willing to go this journey. Yes, we do help clients.
But how often do you review your client's portfolio? It's regularly or it's yearly on year-on basis, or it depends on the report?
The frequency changes, but one of the things that we do is whenever we underwrite a risk, we send our risk engineers to the plant. We do what we call our physical risk rating, and on that basis we give a set of suggestions in terms of what they can do, and on that basis we decide to underwrite the risk. But during the course of the year, one of the things that we, for example, do is we do a lot of data analytics to figure out where some of the small claim events are happening, for example. So just to give you an example, one mobile tower company, we were seeing a lot of small claims coming from across the country, and we analyzed the data and we went back to the client and showed them the analysis in terms of what was happening from which part of the country. And that tells them that there is probably an opportunity to do a better risk management practice in that particular location where the events are coming more frequently. So that's something that we do on an ongoing basis with our clients.
The general complaint is that risk managers are spending disproportionate amount of the time on controls, compliance and monitoring activities, although their real value lies elsewhere. Your comment?
Look, someone has to control and monitor, right? So I won't blame the risk managers in this. But the real issue, as I see it, is that risk management cannot be outsourced to risk managers. Risk management is core to your business. So it's very important for even the business managers to appreciate, understand and comprehend the impacts of his or her decision in terms of the residual risk that you create for your organization. And it's equally important for risk managers to sit down with business managers and understand the ground reality of what is doable and what is not doable, and be more solution oriented. You can't just say that you can't do this, you can't do that. There's no business if there's no risk that is being taken. So it's important to work together and find solutions which work for both. So
basically, you're saying a risk manager cannot operate in isolation.
Absolutely.
So coming to that, how to integrate risk management companies' strategic direction and plan?
I can't give a prescription for every single organization, but what we've tried to do is when we look at start with our business planning, every year, we look at the overall impact. Not only in all decisions that we take, we look at not only the impact in terms of our business growth and business profitability numbers. We also look at the aggregation of risk that we are doing because of the business growth. And being in the business of risk management, we take suitable protection measures ourselves, which could be in terms of buying reinsurance protections, which could be buying in terms of additional software tools to protect the risk that we have. It could be in terms of changing the performance matrices of the business functions to bring in some of these cultural aspects that we talked about. So we do that, and as I said, you have to review it, you have to monitor it, you have to then, based on what you see out of the monitoring, you have to take corrective action.
Finally, the risk of not taking the risk. Entrepreneur's gut instinct versus following the risk model. Do you see an entrepreneur losing out if he follows the risk model very closely? Your comment, Bhargav.
So as I always say that if human beings never took risks, we would have remained cavemen. So it's important for all of us to take some risk, and at the end of the day, without risk, there's no business. But I think it's equally important for people to be conscious of the implications of that risk, and we need to quantify that. At the end of the day, whatever risk we take, when the unfortunate event that may happen does happen, someone has to pay for it. In that underinsurance case that I talked about, either the banker, if the company is bankrupt, pays that price, or the shareholders pay the price. And I think it's only fair for the shareholder to know what kind of risk is being taken in the organization. So risk taking is very, very important. That's what business is all about. But it's important to understand the consequences of the business calls that you're taking.
So you have to take a measured risk in that sense.
Absolutely.
Very well put, Bhargav. Thanks for being on the show. It was a pleasure having you here.
Thank you.
Focus. Ideate. Innovate. Enable.